there, Pat Struby. I'm the founder of Preservation Specialists, and wanted to get this video out to you because of all the craziness that's been going on. I'm sure you've heard about Silicon Valley Bank, all kinds of things going on in the banking community, and wanted to just kind of take you through a few slides. And it's a little different than most of our videos, but this is a different situation, and wanted to make sure I had some notes, but most importantly, get in front of you and kind of give you hopefully a plain English explanation of what we're seeing going on and how it affects you. So I'm going to go to some slides here, and the three big things we'll hit on is what happened with Silicon Valley Bank, what might happen next, and of course, what should we do? How does it affect us? The first thing we want to say is we think that you are going to be okay if you're a client of ours. We are in great shape, so we want to definitely first hit on the most important thing, because we all want to know, how does this affect me? So we're still gathering updates from every single company we work with. This is a spoiler for the rest of the video, but the bottom line is the people that are going to be at risk with Silicon Valley Bank are people who own stock in the bank or who owned bonds with the bank. And that would be the same, it appears to be for any other bank problems that we have going forward. So as long as you aren't directly investing in those stocks or bonds, it appears that we should be in great shape. So that's where we believe we stand right now. Let's take you back through a little bit of background. How do banks make money, and then I think this is helpful to see kind of what actually happened here. So a bank, what they do is they take deposits from us in checking accounts, savings accounts, CDs. Most of the time, what they're trying to do is they're trying to lend that money out. I actually worked very closely with some smaller to mid-sized banks earlier in my career, got to know the bank presidents, and in my understanding, that was the ideal for them, is to have the proper amount of deposits and loans, and that allowed them to provide safety, and then also they're trying to increase their profits. Now, what happens is if they get extra deposits, either they can't or shouldn't make those extra loans. So in that case, as you see here, they're going to reinvest those funds, typically into bonds, and then hopefully earn more interest on those bonds than what they're paying out. So what happened is Silicon Valley Bank failed, and so there's a number of steps to how this happened. So first of all, it's a very unusual circumstance. Most banks are going to have customers of all different types. Silicon Valley Bank, as you can tell from the name, a little different than us here in the Columbia, South Carolina area. Their clientele is primarily venture capital. So these are companies that are startups. A lot of times in those cases, they are generating a lot of value, but not a lot of revenue. So that's a little unusual. Or it might be people that were investing in these small startup companies. Well, what's happened over the last few years, the Fed flooded the economy with cash after COVID. And what happened, as you can see in the slide here, is the deposits at the bank more than tripled in just 3 years, which is a crazy amount. So a lot of this, interesting to see how these things are kind of intertwined. So what the bank did was they either couldn't or they shouldn't have lent that money out. And so all those extra deposits they invested, it appears to our understanding right now, is that money went into long-term bonds. Well, so the Fed flooding the economy with extra cash helped create these extra deposits. Well, then guess what the Fed did? The Fed started jacking interest rates up because we started having so much inflation. Well, when interest rates go up, value of bonds goes down, and the longer term the bond is, the more it's affected. So in a very short period of time, the value of the bonds the bank was invested in dropped by 18%. Now, if they were able to hold those bonds to maturity, it's our understanding they probably would have gotten the full value back. But of course, that's not what happened. So what started happening as the economy has been slowing down, as interest rates have been rising, is those venture capital firms, they started spending more money than they were taking in. So instead of having all being flooded with cash, they were actually needing to spend some of that money. So they were starting to use some of the deposits, the excess deposits at the bank. And it appears again from the as the information's coming out and we're taking it in, it appears that the interest rate risk was poorly managed. First of all, that it seems like the bank had very long-term bonds, which is the worst possible scenario when interest rates are going up. And the second is it appears they didn't hedge those risks at all, which certainly a bank is capable of doing. So, so basically, what happened is they needed to raise money to improve their finances. They went out and announced that, and it created a run on the bank. And if you think about, we have all probably seen pictures of the Great Depression, and the line of people going around a bank. And of course, that's not what happened this time. It's able to be done with the click of a button. And incredibly, from what we've read, the bank had about 200 billion in deposits, and within a couple of days, 42 billion was withdrawn, which is just an eye-popping number to see. So that caused the bank to fail. It was the 16th largest bank in America at the time. Now, this was happening late last week. What happened was officials worked very quickly, which I'm very impressed with. And the bottom line is the U.S. Treasury has agreed to serve as what we call a backstop. Some of the phrasing that we've seen is they're essentially guaranteeing every bank deposit in the country, which is really remarkable. This is being paid for by a fund that is funded by fees collected from banks. And also, they've created a new program to lend money to banks if that's necessary. The most important thing, if you're like me, I'm thinking, okay, are my tax dollars paying for this thing? As of right now, every single person has said taxpayers will not be funding this. So kudos to the officials if they're able to pull that off. That's always our biggest concern. Anytime government's getting bigger and bigger, and if we're having to foot the bill. So if that's not the case, we'll be very impressed. We'll be certainly watching that and hope that will continue to be the case. The other thing that is important to know is, so who loses out? Well, if you owned stock in Silicon Valley Bank, or if you had a bond with the bank doesn't exist anymore, and you are not being bailed out like some of the companies in 2008. So those funds would be lost. Obviously, if you were an employee of the bank, that's a problem for you as well, because the bank doesn't exist anymore. So there's people that are still going to be harmed in this scenario. But so many of us, of course, the first thing we're wondering is, if enormous banks are failing, is my money safe? Am I going to be okay? And right now, it seems like for the vast majority of us, that is going to be the case. So how does that affect us? What should we be doing? The first thing, of course, and we cannot know the answer to this, what people are wondering is, will other banks be affected? So we'll be watching this. We'll be continuing to monitor the markets and the news and see what's going on. We certainly do not expect all the banks to fail or anything like that. We're waiting. The backstop that the Treasury is providing should provide a lot of stability, which we commend them for. So we'll see if that holds up. One thing I would still say, though, is even though we're being told deposits above $250,000 will be protected, I don't know that I would be real comfortable with that. We've always advised our clients, probably is smart not to have more than $250,000 in any one bank, certainly per tax ID. So if you're a married couple, you can have up to $250,000 in each person's tax ID. Keep in mind, though, if there is a lack of cash in some of these entities, FDIC does not have to provide that within a day or two or something like that. Now, we're seeing and hearing that's the plan right now, but it's one thing if that's theoretical for people out in California that we don't know. It's another thing when it's your own money. So just keep that in mind as far as how much you have exposed to things like that. The main thing I want to say, though, is prepare for volatility and a lot of noise. The markets are definitely going to be shaken by this. We have a lot of people that are predicting a recession in the next year. Typically, that means the stock market is shaky or has a drawdown prior to that. So it's going to be fascinating to see if this helps trigger something like that. Most important thing is we like to do a monthly commentary here. My commentary that's coming out later this month is actually on the financial media and the fact that they make money when we pay attention to them. And we tend to pay attention to them when they make things when we're scared, and that usually happens because they scare us. So just please remember that. Please don't let the media scare you into worrying and having sleepless nights. Have a plan, work your plan, and historically that has worked out very well. One thing to consider is, maybe have some cash on hand. That's different for everybody. For some people, a few $100s. For some people, maybe a few $1,000s. There's not a tried and true rule to that, but certainly if it's possible that your bank is going to have some issues collecting funds, in the short term, maybe having a little bit for emergencies could be valuable. Finally, if you're working with us, we would always say, do not worry. That's the reason. This is the whole reason we believe in diversification. One of the investment companies we work with summarized their thoughts perfectly. They said the value of a hyper-diversified portfolio is it never matters until it matters. And I think we're there right now. It's the reason we try to have your money divvied up into a number of different places. We try to find many places that have no risk, like a bank account up to FDIC limits, or an annuity with principal guarantees. And when you have funds that are invested, we want to have that divvied up into things that are backed by assets as much as possible, such as real estate and things like that. So a lot of thought goes into how your portfolio, or financial house, as we like to say, how it is situated. And we believe that where your funds are right now is the right place to be. If that changes, we'll be in touch with you. But I hope you found this helpful, and I hope you find it calming. We think everything's going to be okay, but we will continue to be on the watch, and we'll be in touch with you with further updates.